Welcome back. In the next few minutes, I'm going to talk about a concept called pooled income fund. A pooled income fund, also known as Section 642 of the Internal Revenue Code, which talks about a charitable trust. This is Rav Garuda with Meaning of Money. A pooled income fund becomes extremely attractive when the interest rates are really low because the calculations will give you a much higher tax deduction. Right now, the 30-year bond, the government bond, is yielding only 1.4%, which means if you put away $1 million in that bond and buy the government bond, you can only get just a little bit more than $1,000 a month interest. So it doesn't really feel like a millionaire, right? But unfortunately, that's what you have. However, there is a different way of taking advantage of this, which is to put this money, whatever money you have, for instance, $100,000, and let's say you're 70 years old. So if you put this money into a pooled income fund, which is a charitable trust, it doesn't mean that you gave away that money forever and you get nothing back. In a pooled income fund, what happens is you have a right to income from this money for the rest of your life, as long as you live, and if you wish, as long as your spouse lives. That's called a joint and survivor income option. And that's for 2 lifetimes. In some cases, you may also say, hey, I have 3 children. They're all 50, 52, 54, and I want income for them. You can include them as well. But the best part of the pooled income fund is the moment you put money in, you're entitled to a tax deduction. And that tax deduction can be between 70 to 80%. In other words, if you put in $100,000, you get a tax deduction for $75,000. What can you do with that tax deduction? Well, let's also assume you have money in an IRA. So what you could do is you could pull out $100,000 from your IRA and convert that to a Roth IRA. So now you have created 2 buckets of money. One bucket of money has a Roth IRA. Another bucket of money has a charitable trust or a pooled income fund with $100,000 in each bucket. So if you are 70 years old and if your children are in their 40s and 50s, you have 2 options. You can take income as long as you and your spouse live, which means 80% of that money that you put in has created a tax deduction, and you have to pay tax on the Roth conversion for only $20,000. You see, anytime you convert from IRA to Roth IRA, you have to pay income tax, right? So how much income tax do you pay? Well, normally you converted $100,000, so you got to pay tax on $100,000. But you have an $80,000 tax deduction, let us say, for example, then you have to pay tax only on $20,000. So if you're in 20% tax bracket, your tax is $4,000. So now you have $100,000 in a Roth IRA, and the money is going to grow tax-free for the rest of your life, as long as you live, as long as your spouse lives, and then for 10 years after you both pass away. So you see, between you and your spouse, plus 10 years, you could have income for 40 years. So how much would $100,000 become in 40 years? If you don't need to withdraw any money, if you just want to accumulate that, there is a thing called Rule of 72. If it doubles every 10 years, the 100,000 will become 200,000 in 10 years, $400,000 in 20 years, $800,000 in 30 years, and $1.6 million in 40 years. That's a lot of money. So this is an opportunity you have with a Roth IRA. And the only reason people don't do that is because you have to pay taxes on that $100,000. However, the tax deduction that you receive will reduce the tax on $100,000 to only $4,000 if you are in 20% bracket. And that also is only one-time tax. So you pay a one-time tax to accumulate money for the rest of your life. In the meantime, the money in a pooled income fund, grows tax-free. It can also give you income tax-free. So suppose you take the option of taking money as long as you live and as long as your spouse lives. And let's assume that between the two of you, you live for 30 years and you get 5% from that. So 5% of $100,000 is $5,000. If you get income for 30 years, that is $150,000. So you got your money back, that $150,000, and at the same time, you're able to accumulate as much as $1.6 million in a Roth IRA if you wish. Now, there are some people that would say, well, I like everything, but I don't like the idea of giving away $100,000 to a charity after I pass away and my wife passes away. I would like to find a way to leave that money for my children. Well, you could do that also. All you have to do is take a little bit of money from your Roth IRA and you can buy a life insurance policy so that when you pass away, you have created three different assets. You have created a Roth IRA for yourself, for your children, or your spouse, and then you also have given $100,000 to a charity of your choice. And on top of that, you have created $100,000 in a life insurance policy or more for your children or grandchildren. And you have basically created a lot more opportunities with your pooled income fund. If you like this idea, please give me a thumbs up and also click on the link below so we can send you more information. And please ring the bell so that we can alert you when we post more videos. Thank you very much. My name is Rao Garuda and this is Meaning of Money.